Most people think real estate success comes down to picking the right property. But what actually determines outcomes is the cycle you are buying into. You can have strong cash flow, disciplined management, and still experience compression if liquidity tightens and refinancing costs rise. The property matters, but the funding regime matters more. When liquidity is expanding and credit is easy, cap rates compress and operational improvements translate into higher valuations. When term premium rises and long-duration yields reprice higher, even well-run assets feel pressure because net operating income gets multiplied by a higher required yield. That is the mechanism most investors overlook. Within our strategy framework, we are operating in a late Phase 1 environment, transitioning toward early Phase 2 pressure. Liquidity has not collapsed, but it is no longer accelerating cleanly. Labor is softening beneath headline strength. Credit spreads remain contained, yet private credit stress is emerging at the margins. Long-term yields have shown sensitivity to fiscal issuance and auction dynamics. When those elements combine, the probability of multiple compression increases even if rents are stable. We currently assign roughly a 60% probability that Phase 2 pressure builds into mid-2026, meaning valuation sensitivity rises before a clear credit event. A deeper Phase 3 breakdown, where forced liquidity dynamics dominate, carries roughly a 30% probability into late 2026 if credit spreads widen and funding markets tighten. A continued benign melt-up into early 2027 carries lower probability and would require re-acceleration in liquidity momentum and renewed labor strength. The key transmission channel is refinancing. If policy rates ease, but long-term yields remain elevated because of term premium expansion, the rollover trap appears. Borrowers refinance at higher costs, transaction volumes freeze, and cap rates drift upward. That is how valuation resets occur without a dramatic headline crash. If you find this phase-based approach helpful, subscribe so you can track how these signals evolve over time and understand when phase pressure shifts rather than reacting after price moves. Our goal is to focus on sequence, not noise. None of this is investment advice, and our analysis is strictly educational and probability-based. What we are watching now is confirmation versus invalidation. Confirmation would include sustained widening in credit spreads, deterioration in hiring rates, and long-duration yields that refuse to fall despite softer growth data. Invalidation would include broad credit stabilization, renewed liquidity expansion, and durable improvement in labor quality. Real estate is not just a property decision. It is a timing decision within a funding cycle. Investors who respect liquidity sequencing preserve optionality and deploy capital when asymmetry improves. That discipline, not optimism, is what compounds over cycles.